So what is the reason that you rebalance your portfolio? Are you rebalancing your portfolio to improve your performance, or are you doing it to manage your risk? We are going to explore this topic in today's video. I have a great presentation lined up for you, and I think the results are going to shock you. When you see what happens if you perform quarterly or annual rebalancing for 10 or 20 years, the results become very different versus not rebalancing. And then when it comes to risk, you might not need to rebalance as much as you think you do or what you've been told to do. I've been a financial advisor for over 25 years. After the first decade of the 2000s, it seems like every investor I've met wants rebalancing. Everyone has become convinced that rebalancing is some great feature that they need to have in their retirement portfolio. But after you see today's presentation, you're going to start questioning, is rebalancing worth it? For our analysis, we are going to use a very simple portfolio. 60% SPY, that's the S&P 500 ETF, and 40% AGG. That's the aggregate bond market ETF. We're going to compare the impact of quarterly rebalancing, annual rebalancing, and no rebalancing for someone who invested 5 years ago, 10 years ago, 15 years ago, and 21 years ago. We will also look at some select periods like 2004 to 2009, 2004 to 2013, 2004 to 2019. And the reason for that is to give us a wide-angle lens view of different market environments, a bull market versus a bear market, or incorporating a recession, for example. And finally, we are going to look at the risk from holdings drift. Does not rebalancing for a long period of time bring about more risk for your portfolio when compared to a quarterly or annual rebalancing strategy? The reason that I chose SPY and AGG for this analysis is that they are very liquid. They have a very low expense ratio. The 60-40 portfolio net expense ratio is only 7 basis points, and there's a lot of trading history. These ETFs go back a long time. The analysis starts in 2004, right after AGG started trading, which was the end of 2003. Our first time period for analysis will be the last 5 years. We're looking at 3 model portfolios: 60-40 SPY AGG no rebalance, that's the purple line; 60-40 SPY AGG quarterly rebalance, that's the orange line; and the blue line is 60-40 SPY AGG annual rebalance. We're starting with $1 million in all 3 portfolios, and we're charting total return for the last 5 years ending on December 31, 2024. We can see that the purple line was the best performer. If you did not rebalance this portfolio over the last 5 years, you ended with $50,000 more in your portfolio. Now, what you're going to see as we go through this presentation is that the longer you are in a rebalancing strategy, the more it can potentially cost you. Over time, the difference between not rebalancing and rebalancing can really grow. It can cost you a substantial amount of opportunity cost. Here is the exact cost of rebalancing over the last 5 years in a 60-40 SPY to AGG portfolio. Annual rebalancing cost you $54,000. Quarterly rebalancing cost you $51,000. We're using no rebalance as our baseline. The difference between the baseline and annual rebalancing or quarterly rebalancing is how much you lost or potentially gained. We will see some situations where rebalancing made you money. If you had invested in a 60-40 SPY AGG portfolio 10 years ago and you did not rebalance, you came out over $200,000 ahead when compared to a quarterly rebalance strategy or an annual rebalance strategy. Using December 31, 2014 as a start date for our 60-40 SPY AGG portfolio, 5 years into the strategy, you are 15,000 behind with an annual rebalance, 14,000 behind quarterly. But at 10 years, you are 239,000 behind with annual rebalance and $233,000 behind with a quarterly rebalance. Over the last 15 years, the the difference between not rebalancing and rebalancing really starts to add up. If you had invested $1 million in this 60/40 portfolio 15 years ago, and you chose to quarterly or annually rebalance, you ended with $3.8 million. But if you did not rebalance, you ended with $4.7 million. Over $900,000 of difference. Here are the numbers for the 60/40 SPY AGG portfolio using 12/31/2009 as a start date. In 5 years, you are 26,000 behind with annual rebalance or 21,000 with quarterly. In 10 years, you were 175,000 behind with annual rebalance or 165,000 with quarterly. And in 15 years, you were $907,000 behind with an annual rebalance strategy or $884,000 behind with a quarterly rebalance strategy. If you had invested in the 60/40 SPY AGG portfolio 21 years ago, after AGG started trading, at the end of 2024, not rebalancing would end up with $5.4 million versus $4.7 million for annual rebalance or quarterly rebalance. Now, this is where things get really interesting. It's hard to see on this chart, so I'm going to show you a data table here in a minute so we can clarify. But for the first 15 years of this graph, the rebalancing strategies were actually ahead of not rebalancing. So by quarterly or annual rebalance strategy from 2004 into 2018 or so, you were making more money. Rebalancing was a benefit to your portfolio. Not rebalancing was hurting you. It's only been in recent years, due to the great bull market that we've been in, if you had 2004 as a starting point, that not rebalancing has really pulled away from the rebalancing strategies. During this time period where we had a serious recession in 2008, the volatility in the market made rebalancing a little bit better. But what you can also take away from looking at this chart is that in the long run, not rebalancing is likely to put more money in your portfolio versus rebalancing. And the reason for that is that eventually you're going to catch a long-term bull market. And when you get a long-term bull market, not rebalancing is going to end up growing faster. Here is the gain or loss from rebalancing using a 60/40 SPY AGG portfolio with a December 31, 2003 start date. In 5 years, you are $26,000 ahead by using an annual rebalance strategy. If you were rebalancing quarterly, you were $6,000 ahead. In 10 years, an annual rebalance strategy puts you $90,000 ahead, while a quarterly rebalance puts you $61,000 ahead. And in 15 years, you were $66,000 ahead with annual rebalance or $33,000 ahead with quarterly rebalance. After 21 years, you were $656,000 behind with annual rebalance or $717,000 behind with quarterly rebalance. So for this time period, quarterly rebalance was the worst performing strategy. One other thing to keep in mind is that your results could be different from what you see here if you are paying commissions to a broker or advisory fees for these ETFs. Now let's talk about rebalancing to stay within a certain risk profile. Some people rebalance because they want to maintain a certain risk position with their portfolio. So I thought it would be interesting to see how much could you potentially lose if we went through a 2008 type scenario again after you had not rebalanced for 21 years. In other words, we take the 21-year ending value of not rebalancing, and then we look at what the drift is on the holdings. How much is now in equity and how much is now in bonds, and what that asset allocation would have lost in 2008. And then we compare that against the quarterly or annual rebalance strategy, which is just a straight 60/40, and how much would that portfolio have lost in 2008. And then we can get a really good idea of what happens if you don't rebalance for a long period of time. Your portfolio grows a lot more, but now it's grown into a different risk category. So how much could you lose? Let's take a look. If you had invested in the 60/40 SPY AGG portfolio 21 years ago, here's where your current weights would be today, assuming you had never rebalanced. You would have 86.64% in the S&P 500 and 13.36% in the bond market. And that's because over the last 21 years, bonds have been a poor performing asset and equities have really grown. So over this time, the equity position has grown and grown in your portfolio, and the bond position has become smaller, which means that your risk profile has changed. You now have a more aggressive portfolio in terms of volatility measurement. Now, for all of you out there who rebalance your portfolio to reduce risk, you're going to find these next couple slides to be very interesting. We're going to take the 21-year ending value of the different portfolios, and then we're going to use the 2008 losses. And for the drift portfolio, the no rebalance portfolio, I'm going to use 86+% in SPY and 13+% in AGG, and then recreate the loss from 2008, and then compare that against the 60/40 SPY AGG portfolio for the lower value rebalance portfolio to see where do we end up. What is the bottom line here? It's really fascinating. Here are the 2008 losses for the 60/40 SPY AGG portfolio. You could see the blue line, that's the annual rebalance, lost 18.92%. The orange line, which is the quarterly rebalance, lost 20.57%. And the purple line would be what the portfolio has grown to by 2025. If you had never rebalanced, you would have 86.64% in SPY and 13.36% in AGG. And so that portfolio mix, the purple line, in 2008 lost 30.83%. Now let's translate that into the current portfolio values to see what does a 30% loss look like on the portfolio after it's grown for over 21 years. Here are the 2008 losses for the three rebalancing strategies, quarterly, annual, or no rebalancing, using the end of 2024 values, i.e. after you had invested for 21 years, here's how much money you have. Now let's recreate 2008, assuming something like that were to happen in the not too distant future. How much would you lose? And what we're really interested in is what would the loss be on the portfolio that was never rebalanced. This is where it gets really interesting. Here's your no rebalance line. We're now 86.64% SPY, 13.36% AGG. We would have lost 30.83% in 2008 with this portfolio. So as of 12/31/2024, we have $5.4 million. That's a $1.67 million loss. You end with 3.755. But look at the quarterly rebalancing numbers. If you had rebalanced quarterly for the last 21 years, you would end with 4.7 million. 2008, that strategy lost 20.57. That's a 969 loss, 969,000. You would end with 3.74 million, a little bit less than the 3.755 if we never rebalanced. And finally, the annual rebalance, we had an 18.92% loss in 2008. Our value in 12/31/2024, 4.77. That would put us at 3.869, recreating 2008. So you see that all three of these rebalancing strategies kind of end in the same place, but the no rebalance strategy gives you the most upside in the long term and the best shot at wealth creation. So it really gets you thinking, how often should you be rebalancing your portfolio? And when it comes to risk, think about this for just a minute. I'm getting to the same spot. In fact, I'm ahead of the quarterly rebalance. So is it worth it to continually rebalance your portfolio, especially quarterly? After you look at all this data, it's inconclusive to me if quarterly is any better than annual. There are times when annual beats quarterly and vice versa. I think what we can be confident in is that if you plan to hold investments for a long time, like 20 years or longer, you will most likely end up with more money if you don't rebalance. Now, coming back to risk, this is a big loss here, this 1.6 million versus 969,000. Actually, they're both big losses. But if you end up at the same place, does it really matter? Now, I think rebalancing is a good idea, especially if we're in a bear market. But the hyper focus that many people have on quarterly rebalancing, I think that's too much. I think a better way to go about your rebalancing is to rebalance every 2 or 3 years. Give your asset classes and your investments more time to move and open up your tolerances a little bit. Don't rebalance every 3 months. Too many people do that. I don't think it's a good idea. And this data shows that sometimes quarterly rebalancing can put you ahead, but in a number of these instances, quarterly rebalancing puts you behind. And if you can recognize the pattern of the market, where you are at with respect to the business cycle, that can also give you some clues on what kind of rebalancing strategy you might want to be using. For example, the stock market has a very easy to identify long-term pattern. Green arrows, bull markets, that's where not rebalancing is going to help you. The red arrows, bear markets, that's where rebalancing is likely to help you. So knowing where you're at in the business cycle can help you decide how much more frequently or less frequently you should be rebalancing your portfolio. If you have questions about your investments, please give my office a call. We would be happy to give you a second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.